Most people have never heard of the repurchase agreement or repo market, but it moves roughly $1 trillion every single day. In a repo trade, one institution lends cash overnight, taking government securities as collateral, and gets the cash back the next day with a small amount of interest. Banks, hedge funds, and money market funds all rely on this market to manage their day-to-day cash needs. It is meant to be the most boring, reliable corner of finance. After the 2008 financial crisis, the Federal Reserve bought trillions of dollars in bonds through quantitative easing, which left banks holding an enormous pile of reserves, deposits banks keep at the Fed. Those reserves peaked at about $2.8 trillion in 2014. Starting in 2017 and continuing through 2019, the Fed reversed course, deliberately shrinking its balance sheet and letting reserves run off, on the theory that the financial system simply did not need that much spare cash sitting around. By mid-September 2019, that years-long runoff had pushed aggregate bank reserves down to a multi-year low of less than $1.4 trillion. On paper, this still sounded like a lot of money. In practice, reserves were not evenly spread across the banking system, and several major banks were already holding less spare cash than they wanted, for reasons including post-crisis regulations that reward holding safe, liquid assets like reserves and treasuries. On September 16, 2019, two routine, individually unremarkable events landed on the exact same day. Corporations made over $100 billion in quarterly tax payments, pulling that cash out of the banking system to send to the Treasury. At the same time, $54 billion in newly issued Treasury securities settled, meaning dealers had to pay for bonds they had just bought. Together, banking system reserves fell by about $120 billion over those 2 business days. A sudden, sharp drain layered on top of an already thin cushion. The result hit the next morning. On September 17, 2019, the secured overnight financing rate, a key benchmark for these loans, jumped from 2.43% the day before to above 5%, and some trades during the day reportedly executed as high as 10%. The effective federal funds rate, the rate the Fed actually targets for the whole economy, was pushed to 2.3%, above the top of the Fed's own target range. Lenders with cash to spare were suddenly demanding extraordinary rates from borrowers who needed it. The New York Federal Reserve, which actually operates in these markets day to day, responded within hours. On September 17th, it offered up to $75 billion in overnight repo operations against Treasury, agency, and mortgage-backed securities collateral, and ended up providing $53 billion in additional reserves, with much of the worst trading already having happened before the announcement landed. It then ran the same $75 billion operation again on September 18th, 19, and 20, every single one fully subscribed by institutions desperate for cash. The intervention worked quickly. By September 20th, 2019, repo rates had fallen back to around 1.75%, and the federal funds rate eased to roughly 1.9%. The New York Fed announced it would keep offering these operations, and it continued providing daily liquidity to the repo market all the way through June 2020, well past the point the acute spike had ended, as a precaution. Within weeks, the Federal Reserve drew the obvious conclusion. Its own balance sheet runoff had drained reserves further than the plumbing of the financial system could comfortably handle. In October 2019, it announced it would resume purchasing Treasury bills at a pace of about $60 billion a month through at least the second quarter of 2020, specifically to rebuild an ample level of reserves. Fed officials were careful to describe this as a technical operation to manage reserves, not a return to the post-crisis quantitative easing meant to stimulate the economy, even as the balance sheet expanded again either way. None of this made front-page panic the way a stock market crash does, but the mechanism is the one that quietly keeps credit flowing everywhere else. Banks rely on smoothly functioning short-term funding markets to manage the deposits behind your savings account and the capital behind the loans they make. When that plumbing ceases, even briefly, the cost and availability of credit across the wider economy is what is ultimately at stake. The general lesson, not specific to any one investment, is that the parts of the financial system nobody talks about are often exactly the parts worth understanding, because they tend to break quietly, without warning, until a central bank has to step in within hours to keep the rest of the system running.